Confidence without patience is effing dangerous. How is it possible that some people have been able to make life-changing gains with Bitcoin, while others heard about Bitcoin very early on, but then sold already after a gain of just 1 or 200%? What's different here between those people? What's psychologically, fundamentally going on? How can we avoid that if we find a winner early in the future, and we're not going to sell too early, that we actually have the chance of making life-changing gains? Because I talked with so many people that told me at one point I did have 10 Bitcoin, or I did have 100 Bitcoin even. But then I sold it all, I speculated with the altcoins, and I lost it on the altcoins. Or I sold it all in order to buy just something for consumption, right? Some technology gadget. And if I had just held onto that Bitcoin, I'd now be a millionaire and beyond. I wouldn't have to work anymore. I hear this kind of story time and time again. But fundamentally, why did those people sell too early? And let's say we find the next big hit. How can we avoid that we are going to sell that early? What I think fundamentally is going on is that the people that sold out of a specific type of fear. A fear of not realizing gains, of having been a paper millionaire and never taking any profit along the way. A fear that the asset that they bought, so Bitcoin in that case, might just be hot air and it might all come back crashing down. It might have just been a Ponzi scheme. It might have just been some elaborate marketing scam that then in the end goes back to zero. There have been many voices that Bitcoin will go down to zero. And so then, as per extension, maybe there is the fear that all of those gains were just due to luck. They were not really because of any inherent skill. And to a degree, right, when we make quick gains with any investment, we do feel lucky because partially, of course, we probably were. I believe those fears come out of a lack of conviction because the people that made life-changing gains in Bitcoin, they tended to be Bitcoin maximalists. They tended to follow Bitcoin out of its fundamental properties. So they bought into Bitcoin and not into many altcoins because Bitcoin did not have a central team, because Bitcoin was kind of decentralized, right? There was not just a central company that would then change potentially the blockchain. There was very clear tokenomics that couldn't get changed. The number of issued Bitcoin was completely transparent, and it was born out of the motivation to do something against traditional finance, to do something against the corruption of traditional finance, right? The very first block that was mined for Bitcoin, the Genesis block, had a reference to a news article that was published how there was another bailout, I believe in Germany, for the bank. So Bitcoin, to a degree, was a protest, while it was almost religious money. It was some kind of asset that was bought out of conviction, not just in order to make a quick buck, not just in order to flip this quickly to make some profit. And so then the fundamental question is, how do we gain enough confidence that in the end, if we do have a winner, we keep on holding onto that winner, that we let our winners ride? I believe an allocation towards a portfolio needs to be in line with the knowledge about a certain asset class. So if you know a lot about property, right, if you're a property agent, I think it's okay to have the majority of your wealth in property because you do know what kind of properties have a higher likelihood of outperforming the market. If you know a lot about stocks, let's say about specific stocks, technology stocks, because you work in the technology market, you know what kind of technology company is likely going to get more adoption in the future. You know what is the best cloud infrastructure provider, you know where the trends are headed, then it's okay to have more exposure to technology stocks. And the same is true for Bitcoin. The issue is many people bought crypto just because they saw the volatility, just because they saw the potential quick gains. Bitcoin, for example, after Mt. Gox and Silk Road collapsed, was at $150 per coin. And it then went up in a single bull market to $20,000. And very few people have been able to buy at $150, have been able to sell at close to $20,000. Right? Most people sold along the way, or they just kept on holding and went through the bear market where it went all the way down to 3.5K again. Very few people are able to time the bottom perfectly, or the top perfectly. But some people have been able to hold onto Bitcoin for longer than others. It was really the hodlers that made most money. The people that did that, they simply learned about the fundamentals of Bitcoin more. They simply understood why Bitcoin should go up long term. They understood the tokenomics. They understood the fundamental properties of having self-custodied money that can't get confiscated away. We also see this with beginners, right? People that just start out with investing, they're just used to measure everything in US dollars. And so thus the vast majority of their net worth tends to be in US dollars. It seems to be the safest. So in other words, we tend to put our money where we feel most comfortable. We tend to put our money where we have most confidence, where we know most, where we've got most experience. And so if we don't want to sell a winner early, we have to learn more about that winning thing. If we've got an asset that suddenly appreciates very quickly, we have to learn a lot about this. Is it still worth to hold it? We shouldn't just sell because it went up. We should figure out, is there potentially more upside? And if yes, why? What's the fundamental reason for a rally and how much longer could it last? It's all about confidence. The confidence in an asset has to be in line with the portfolio allocation. It's all about knowledge. How much do we know about a certain thing? And so I think that's also one of the reasons why many people have the vast majority of their net worth tied up in property, tied up in their own house. Because a house is tangible. The price of a house seems to not matter that much, right? We have to live somewhere. And so why don't we just buy a big house? Houses appreciate over time. And even though they don't really do this, it's really the US dollar that goes down over time. It feels okay to park purchasing power in a property. And then it also suddenly feels reasonable to do that with a lot of leverage, right? To go 10x long the property market, or in other words, have 10% of a down payment and borrow the remaining 90%. And do this also with a lot relative to income, right? To take on debt that's multiple years of income. Nobody would do this with an altcoin because we don't have the confidence in an altcoin. Very few people would be willing to do that with Bitcoin. But everybody seemingly is okay to do this with property. Again, because we've got more confidence in property. Property prices also fluctuate, right? During the global financial crisis, we saw property prices drop by 30% on average. Some properties went down by 40, 50%. If you are 10x levered, right, you're in massive negative equity and you still have to serve your debt. And if you were to sell that house, you would have to pay even more money just to be break even again. So buying property with that much leverage, with that much money is hyper risky. It's much more risky than taking a small personal loan of, say, a few months worth of income and put this into Bitcoin. But very few people would do this, right? Very few people would consider to take, say, 6 months of their income as personal loan and then suddenly buy Bitcoin with it. But nobody blinks an eye to take multiple years of income and put this as debt on a new house purchase. And the only reason is really confidence. It's really just knowledge. It's really just familiarity. It seems like the property game is safer because it has been working for a long time. But that's a very dangerous heuristic. Just because an approach worked for a long time does not mean that it will continue to work. Sometimes the best performing asset class is not the one that used to work for the previous generation. There are times where regular stocks do well. There are times where gold is doing well. There are times when technology stocks do better. There are times where it's best to be just in cash and in bonds. And those periods, they can last for decades. Just because your parents made a lot of money with property does not mean that our generation is going to do the same. Really, we have to somewhat approach this like Warren Buffett. We have to make the distinction between what's the price of one thing and what's its value. And only if the price is low relative to the value we should buy. We should only buy the things that are within our circle of competence. If we understand something, we can buy it. If we don't, we should just have a very small allocation to it, if any. We should not necessarily try to beat that market. It's okay to be over-allocated towards something that we understand. It's not okay to be heavily allocated towards something we don't understand. If something goes up in price, we just have to increase our understanding in alignment with that. And if after we understand the asset class very well, we still think that maybe it's too expensive, then of course it's okay to sell. If you, for example, made a lot of money with silver, right? You bought silver early, silver grew a lot in its value, and you're considering, should I buy, should I sell? The best answer to this question is probably learn more about the silver market. Try to figure out who is mining silver, at what rate are they mining silver, how quickly can they potentially increase their silver production, where is silver actually been consumed, how much is being consumed, how much of the current demand is just ETF demand, how much of it is industry demand. If the demand is going to be battery demand, how much of that is that going to be? How quick is the transition happening? All of those narratives, they might help to shape. There are a lot of narratives around a potential asset, but really it's about quantifying things. It's trying to find out how much is actually being purchased and how much might get purchased and how much might get produced. We then have to measure this in terms of the supply and demand relative to the currently available stock. If you're currently bullish on silver, do you know how much is getting mined? Do you know how much the supply expands? Do you know how much this fluctuates and how elastic the supply actually is? And same for the demand side, right? How much will this actually grow and where is it right now? If you don't have the numbers, all you can do is just make random guesses. And if you can only do random guesses, then very likely you're going to sell too early. If, of course, the fundamentals for silver are set up in a way that it can potentially go higher. Right? It's all about conviction. It's all about knowledge. So in other words, doing a big investment without big knowledge about that investment is a big problem. Those two things have to be in alignment. It's okay to be invested in many asset classes, but I don't think it's smart to try to beat every different asset class. It's not smart to try to become the best real estate investor and the best crypto investor and the best investor in precious metals. Because in order to outperform a market, we have to know more than the average market participant. And it's not just better than the average, probably we have to be in the top 10%, maybe top 5%. It's pretty much impossible to be the top 5% across all of those asset classes. There are full-time investors that know a lot about things, that read about a certain asset class many hours every single day. They've done this for potentially decades. It's impossible to beat those people across all of those different asset classes. It's potentially, if you work hard enough, possible to beat one asset class, but it's impossible to do this with all asset classes. It's okay to be diversified across many asset classes, but if your focus, for example, is on crypto, then don't try to beat the stock market. Simply just buy an ETF for the stock market, get the average benchmark return, and be okay with that. The same is true for property, right? You don't have to find the best property deal. Just buy something that everybody else is buying, something that's very liquid, something that buys and sells frequently, where you know that you're getting just an average deal, but you also know you can exit for the average price very quickly as well. You simply just get the overall average performance of the property market. Again, if that's not your main thing. So very often, especially for highly performing assets, is to learn more about it and potentially do slight rebalances, right? If Bitcoin goes from $150 to $20,000 and maybe you started off with an allocation of 10% of your net worth, suddenly 99% of your net worth is in Bitcoin. Of course, that's not rational either, right? But if you learn enough about Bitcoin, it's maybe okay that over time the allocation moves from 10% to 20 to 30 to maybe even 50% if we can stomach the volatility. So we can, of course, take profit along the way, but we can also increase our allocation if we get more conviction in that particular investment. If you found this video interesting, then feel free to subscribe. I publish videos regularly. There's also a link to Premium popping here on the screen. This is where I discuss those concepts in more detail. There's also a 1-week money back guarantee. So if you do not like Premium, just message me within the first week and I'll refund you 100%, no questions asked. See you next time on YouTube or see you on Premium. Cheers!